Okay. Now we are recording. All right. So many things have changed this semester. It's hard to keep up with what's going on. We had rescheduled your second exam for the 27th. So I think we can stick with that. I will need to send you an email confirming when you can take the exam, because remember, we didn't all take it at the same time. Probably what I will do, I will send you a schedule that we're going to see if we can, the 3:30 thing, we're going to see if we can, if those people can take it earlier, maybe at a regular class time. I'll start with what you did last time. That's what I'll send out, and then I need you to confirm that that's okay. If there's a problem, then let me know, and we can make some adjustments. But we don't need to start from total scratch this time. Remember the exam, we'll go through chapter 30. We've done chapter 27. We're in chapter 26. We will finish that today. Hopefully get started in chapter 28. In chapter 28, remember, you're not responsible for everything in the book in chapter 28 or all the sapling assignments. I did assign the MRU videos. And I believe I said last time that the questions on the exam from chapter 28 will come from the questions over the MRU videos. So, just make sure you understand those questions. Chapter 28 is very interesting. It touches on some material that can get very, very complicated. Okay? And we're not going to go into the complications. But the material, the concepts that it touches on, part of those are really very, very important and very useful for understanding a whole lot of things. So the 28 material, what we cover is very important, but we're not going to get bogged down in a lot of the details. And once we cover that in class, I think you'll see what is important. All right, chapter 26 on GDP. One of the keys to understanding GDP well is to go over the definitions over and over and over. So when you think of GDP, you got to remind yourself, well, what is it? What is the definition? The total market value of all goods. Sorry? All finished or final goods and services produced annually within a country's borders. We don't care who produced it. If it was produced within our borders, then its value is included in GDP. We said there are two different approaches to calculating GDP. What was the first?
National spending approach.
I'm sorry.
National spending approach.
The national spending approach, or the expenditure approach, means exactly the same thing. And what was the equation we used for representing the spending approach? Right. Y, don't forget the Y. Y equals C plus I plus G plus NX. If I just gave you that equation, to tell me what that means, you should be able to say, well, Y represents GDP. GDP is the total value of all final goods and services. And then know that C stands for consumption, investment spending, government purchases, net exports, and understand what is included in each of those categories. And remember that the basic idea is we're trying to figure out how much would you have to spend to buy all of the output that was produced. That was the spending or expenditure approach. We then said a second approach is the factor income approach. You can just remember income. So if you want to remember spending versus income, those are the two approaches. And with the income approach, we're looking at the income going to the factors of production. Factors of production, that just means the resources that are used to produce the output. So, labor, remember we talked about the employee compensation is the income going to workers. Rent is the income going to resource owners who will allow other people to use their property. And we talked about interest, we talked about profit. Add all of those different types of income together, then that gives you national income, and that represents roughly GDP. For our purposes, if we add these things together, that will give us GDP. Kind of a footnote, there are a couple of complications. We are additional adjustments that do have to be made to actually get the two numbers to get the answer from the spending approach and the income approach to come out to be the same. But we're not going to go into those extra complications. They're not that important for us. Basic idea here is when somebody spends $1, that is received by somebody, and it creates $1 worth of income for those people. All right. Continuing on with GDP, this is table 26.1 in your book. We have to think of, or it's important to think about how should we interpret GDP numbers? Here you see different countries. Here you see their GDP in terms of billions of US dollars. And these are ranked from largest GDP to, it's only 10 countries, but the 10 largest, and it's ranked from the largest GDP to the smallest GDP. We have to be careful how we think about these numbers and what conclusions that we draw. These numbers are correct, but sometimes people take correct numbers and they draw incorrect conclusions from them. So when you look over these first two columns, who do you see first? China. Who do you see second? The United States. We could look at that, and some people do, and say, we are losing. We no longer have the largest economy in the world. China's GDP is greater than the US's GDP, so this means we are losing. We are doing something wrong. And that's not the right conclusion to draw, because economic activity is not a sporting event. It's not a zero-sum game. And so when somebody else prospers, whether it's another individual or another country, that does not mean their prosperity is at our expense. What we have seen is China's economy has grown dramatically in recent years. And using this calculation of GDP, their economy is larger than ours. Now, there are some problems when you're comparing one country with another, and some people would say, well, maybe that's not calculated correctly. Let's assume it's right. Okay? That would mean that their economy in total is bigger than ours. But when we go from number one to number two, that doesn't necessarily mean we're doing something wrong. Okay? It just means that they have grown to the point where in total, for the year, they produced more output than people in this country produced in total. Maybe we're doing something wrong. Maybe that they are doing something right, and as a result, they are growing very fast. Okay? So it's useful to see how much their economy has grown, and that it is, in this sense, larger than the U.S. economy. But don't jump to the conclusion that this is something we should be worried about. It's not like an Olympic sporting event where you have the gold, only one person gets the gold medal. There is no gold medal. In economics, thinking about the overall economy, what we are interested primarily in is the economy producing what people want? Is what is happening to their standard of living? And GDP by itself does not tell us about the standard of living. It's telling us how much was produced in total, but look at population. Population varies dramatically. China at this point, 1.3 billion, US only 319 million. So when we're interested in standard of living, GDP isn't the number we should look at first. What should we look at? GDP per capita, which is simply GDP divided by population. It's how much output was produced per person. And we see that, same chart, that if we focus on the per capita numbers, okay, we see that the United States still has the highest per capita GDP. Okay? And China still has a relatively low GDP per capita. It has increased tremendously, and that's great. It means that millions of people are better off, but it doesn't mean that their improvement has been at our expense. Then if you look at other countries, you've got what? Germany at 44,000 is number 2. Then you've got Japan, France, the UK, pretty much the same at number 3. So in terms of standard of living that people are able to achieve, the US is still on top in terms of the major countries in the world. Does that mean we should say, well, that means everything's going great, we just keep doing what we're doing? No. So our standard of living right now is still higher than most people in other countries around the world. But if current trends continue, okay, then at some point, other countries are likely to have a higher per capita GDP, and that means a higher standard of living than people in this country. For their per capita GDP to go up, that doesn't hurt us. Right? They're better off because they're doing something right. That's great. Right? But we shouldn't assume that just because we are at the top at one point in time, that we will continue to remain there. And what we're going to be looking at, especially in chapter 28, will focus on some of the things that will impact what will happen to per capita GDP in the future. One of the interesting things we'll see in 28 is that there are reasons, very good reasons, why low-income countries often will have a high growth rate, and why the countries at the top will tend to have a lower growth rate. Good reasons that happens. We'll see there's some things that, if you're at the top, there's some things we can do to try to keep things improving. All right. The problem of inflation. We have put a lot of emphasis on GDP, obviously. We said that measures how much the economy is producing. Okay? But we do have a problem, and that problem has to do with inflation. When we calculate GDP, what is our unit of measurement? We say GDP is so many trillion dollars. We're measuring value in terms of dollars. So you have to ask the question, is the value of a dollar constant? Is the value of a dollar today the same as it was 10 years ago, 20 years ago, and so on? No. Let me give you a few numbers to think about. If you had $1 in 1929, before the Depression, there's some amount of goods and services you could buy with that dollar. There were no Walmarts, but if there were, you could go into Walmart you could put a certain amount of stuff into your buggy with that $1, and it would be a pretty good amount. Right? By 1950, to buy the same stuff that $1 would buy in 1929, you would need $1.41. In other words, you need 41% more to buy the same stuff. So $1.29 is not the same as $1.50. If you jump ahead to 71, to buy the same amount that $1 buy in 29, you would need $2.37. Okay? We said that the 70s were the period of sometimes called the Great Inflation, when we had a lot of inflation. And in 1981, you would have needed $5.32 to be equivalent to $1.29. 2001, you would have needed $10.36 to be equivalent to $1.29. And the last time I did this calculation, 2017, you would need $14.20 to be equivalent to, or to buy the same amount of stuff that $1 would have purchased in 1929. So can we say, well, a dollar is a dollar? No. Okay. $1.29 is equivalent to $5 in 81, $14 in 2017. So we have a very real problem when we're calculating GDP. We find that in GDP in 1971 was $1.1 trillion. And we find that GDP in 1981 was $3.1 trillion. In just a 10-year period, we had a huge increase in GDP, okay? From 1.1 to 3.1. But what conclusion can we draw? Can we conclude, well, clearly the economy performed much better in 81 than in 71. GDP certainly went up a lot, but we have the problem of inflation because 1971 dollars were worth a lot less than 1981 dollars. So when we see the big increase, we have to stop and ask, what accounted for that increase? In 81, was GDP higher because we actually produced more cars, more houses, more food? Or was it higher simply because we had higher prices? If this is all we have, we don't know what the answer is. So if this is all we have to look at it and say, well, we don't know what to say. We don't know if things got better, if they got worse, if they stayed the same. Inflation causes a huge problem in interpreting our GDP numbers. So we have to have a way to overcome this problem that inflation causes us. And we do. We are going to distinguish between nominal measures of GDP and real measures. This is a really important distinction that we'll make throughout the course. Nominal versus real. When we talk about nominal variables, such as nominal GDP, these are numbers that have not been adjusted for changes in prices. So when we have been talking about how GDP is calculated, we really have been talking about nominal GDP because we haven't been making any adjustments for inflation. What we're saying now is for our numbers to be useful, we have to have a way to adjust for inflation. If there were no way to adjust for inflation, then we'd just say, well, this is just pointless. We're not going to worry with GDP because it doesn't tell us anything useful. But there is a way we can adjust for inflation. Nominal GDP is calculated using price. Nominal GDP is using prices at the time of sale. Okay. So when we calculate, this is going to sound really confusing, but it's really not once you understand. When we're calculating nominal GDP, we use the prices that existed in the year in which the output was produced. So if we're calculating GDP for 2016, then we use the prices that existed in 2016. If we are calculating GDP for 2000, which prices are we going to use? 2000 prices. We use the prices that existed in the year in which that output was produced. Okay? And that means that when we, as I just said, when we have inflation, that creates a big problem for nominal GDP. Because when there's a change in nominal GDP, we don't know what caused it. Did we produce larger quantities, or was it just due to inflation? Notice when we're talking about nominal GDP, increases in production, well, nominal GDP is affected by changes in production and by changes in prices. But when we're talking about our standard of living, are we better off simply when we have inflation? If you go to the store and everything costs twice as much as it did last month, does that make you better off? No, obviously not. Our standard of living goes up when we're able to produce more. So when nominal GDP goes up, if the cause was that we produced larger quantities, that makes us better off. If the cause of the increase in nominal was that we had higher prices, that doesn't make us better off. So it's very important that we be able to figure out what caused nominal GDP to go up. Was it that we produced larger quantities, or was it that we had higher prices? So the question is, how do we remove the effect of price changes? When we have inflation, that distorts nominal GDP. And so the question is, how can we take out that distortive effect of inflation? So here are some numbers to help us think through how this is going to work. And we're going to be making a distinction between nominal GDP. I hope we don't have any tech problems in a minute, because I'm getting a whole lot of lag between when I mark on the screen and when it shows up. That's usually not a good sign, so just don't be shocked if something goes wrong. When we calculate nominal GDP for 2016, we are using 2016 prices, and we're using 2016 quantities. Okay? So everything is 2016. When we calculate nominal GDP for 2000, notice the price we're using. 2000 prices and 2000 quantities. And here we're told that nominal GDP for 2016 was 18.6 trillion. Nominal for 2000 was 10.3 trillion. So between 2000 and 2016, what happened to nominal GDP? Obviously went up a lot. What can we deduce from that? Does that mean that living standards went up? No, we don't know. We look at the increase in nominal and we say, that's interesting, but we don't know what caused it. Did it go up because we actually produced larger quantities? Or did it go up because we had inflation? We just don't know. And to answer that question, to figure out what's really happening on living standards, we have to take out the effect of inflation. We have to adjust for inflation. And that is done by calculating what's called real GDP. Okay? By real GDP, several things you could say about it. Real GDP is inflation adjusted GDP. Remember, we said nominal has not been adjusted for inflation. Okay? Real GDP is a measure of GDP after you adjust, after you take out the effect of inflation. Okay? Another thing we can say about real GDP, we can say something about the prices that are used to calculate real GDP. Okay? When we calculate nominal GDP, which prices do we use? When we calculate nominal, we use the prices that existed in the year that the output was produced. So here, 2016 nominal, we use 2016 prices. 2000 nominal, we use 2000 prices. When we calculate real GDP, we don't use the prices that existed when the output was produced. To calculate real, we use what are called base year prices. Okay. And the base year is just a year that the government chooses. You know, this is the way they take out the effect of inflation. They say, we're going to pick one year, we're going to call this the base year, and that means it's kind of the reference year. Okay? They're saying when we calculate real GDP for any year, we're going to use the prices that existed in that base year. Okay? So we're going to use base year prices when we calculate real GDP for 2016 and 2017 and 2018. When you're calculating real GDP, you only use base year prices. And that's what our calculations here are going to show. 2000 real GDP, right? Here they are using, doesn't say, but they're using 2016 as the base year. So that's a choice. You might think, well, why did they decide to use 2016? We don't know. It doesn't matter. Okay? You have to choose some year to serve as the base year, and it's pretty much arbitrary which year is chosen. Okay? But then once it's chosen, then you use that base year to calculate real GDP in every year, past, future, everything. Okay? So here, look at what we have. 2000 real GDP. Okay? Real means we're going to use base year prices. This means they have chosen 2016 to serve as the base year. So in calculating real for 2000, okay, they're going to look at the quantities that were produced in 2000. But then they ask, well, what were those goods worth? And rather than using the 2000 prices, they use the base year prices. So that's why they've got the 2016 prices, that just means base year prices, times the 2000 quantities gives you 14 trillion. If prices in 2000 and 2016 were the same, then GDP in 2000 would have been 14 trillion. That's really what this is saying. It's saying if you look at the quantities produced in 2000 and you apply to them the prices that existed in the base year, the value of what was produced in 2000 would be 14 trillion. Now notice up here, nominal for 2000 was only 10 trillion. So why is, for 2000, why is nominal 10 trillion, real 14 trillion? What's causing that difference? Differences in prices. You're calculating nominal GDP for a given year. You use the prices that existed in that year. When you're calculating real for that year, you use the base year prices. Okay? Now, how does this help us? We're not done with those numbers. We'll come back to it. Here, this is focusing on is firming up what we mean by real variables. Anytime we say something is in real terms, that just means it has been adjusted for changes in prices, which means it's been adjusted for inflation. Okay? Remember, what is the inflation rate? It's just the rate at which the price level is changing. Okay? So here, this will help us to think through these. This is complicated when you see it at first, but it's not that bad once you understand it, once you look at it for a while. When we talk about nominal for 2016, what is that? Well, it's 2016 quantities and 2016 prices. When we talk about nominal for 2000, then we use the prices and the quantities that existed in that year. Okay? And we already said, looking at nominal, GDP went up from 10 to almost 19 trillion. So the increase in nominal GDP from 10 to 19, that was an 81% increase. Huge increase in nominal GDP. Should we look at that and say, well, wow, clearly the economy did much better? No, we have to say that means the economy may have done much better, but we don't know because that could be due to inflation. So we have to, we can never just look at nominal figures. We have to take out the effect of inflation. We do that by converting into real terms. And when we look at real for 2016, notice, I would say that understanding this is really important because it gets to the essence of real versus nominal. Real for 2016 is telling us the value of what was produced, the quantities produced in 2016 multiplied by base year prices. And we're assuming here that 2016 is the base year. Real for 2000, think about, before we look at the numbers, think about what that would be. Real for 2000, that would be the value of what was produced in 2000, but because it's real, we are not going to use the values in 2000, we're going to use which prices? When we calculate real, we're always using base year prices. And here it's being assumed that 2016 is the base year. So when we calculate real for 2000, we look at the quantities produced that year, but then we value those quantities with the prices that existed in the base year, which what we're assuming was 2016. And when we multiply that out, we get 14 trillion. So let's compare these two numbers. Between 2000 and 2016, GDP went from 14 trillion to 18.6 trillion. If you calculate the percent increase in real GDP, that was 33%. Did the economy improve? Did we produce more in 2016 than we did in 2000? Yes, we produced 33% more. So our numbers here are telling us, yes, the economy did improve. We produced 33% more. But what if somebody says, well, but you know, the improvement was actually 81%? What would the explanation be? The 81%, the nominal GDP does not account for inflation. It does not correct for inflation. So we would look at this 81% and say, wow, that's a big increase. But now that we know what happened to real GDP, we can say most or half that increase was actually due to inflation. It was due to prices being higher. And so that big number makes us think things improved a lot, but it's distorted. It's an exaggeration of what actually happened. And then when we take out the effect of inflation, as we've done down here, then we see adjusted for inflation, output did improve, but it went up by only 33%. Really important to remember when you want to draw comparisons. How did things improve over time or change over time? You cannot use nominal figures. You have to adjust for inflation. And this doesn't just apply to GDP. If you're talking about salaries, you're talking to your grandparents or your great-grandparents, and you say, well, I'm making $7.25 an hour, and they say, oh, you should be thankful. When I was a kid, I was working for a dime an hour. You're really getting paid a lot. You used to say, well, in nominal terms, I'm getting paid a lot. But if you want to make a meaningful comparison, you have to say, well, what has happened to the real wage between the time they were working and the time that you're working? You have to adjust for inflation. We'll go into, over in chapter 31, we'll go through a very interesting and simple way to adjust for inflation, whether you're talking about wages or anything. Anytime you're comparing numbers in different years, the way to adjust is really, really simple. You just multiply something and you divide by something. And we'll show you how you can do that when we get there. Okay, here we're introducing a new term. We're not going to use it much now. We'll come back to it over in chapter 31. And this is the GDP deflator. Okay? Don't confuse the GDP deflator with GDP. We know what GDP is. We talked about it. We got nominal GDP, we got real GDP. The GDP deflator is focused on deflator. Okay? It is not a measure of how much we produced. It is a price index. And it is one way we can measure inflation. And the definition for the GDP deflator is very simple. It's a ratio. The GDP deflator for any year, let's say we want it for 2010, then it's going to be the ratio of nominal GDP in 2010 over real GDP for 2010, and then you multiply that by 100. Just a ratio. Think to help you see what that's showing. We'll just go ahead and use this. In 2016, nominal GDP was about 19 trillion, so we put that in the numerator. Real GDP for the same year was, and here they're using 2009 as the base year. Real GDP was about 17 trillion. So we put nominal in the numerator, we put real in the denominator, we multiply by 100, and that gives us the GDP deflator. Now, what would have happened? What would the deflator be if there had been absolutely no inflation? If prices had stayed exactly the same between 2009 and 2016, what would the prices had stayed the same, there would have been no inflation, what would the deflator be? Now the inflation rate would be 0. The deflator would be 100. Because if there's no inflation, if prices have remained constant, then real and nominal would be exactly the same. So if there's been no inflation, then the numerator and the denominator would be the same. If you divide something by itself, what do you get? 1, you multiply by 100, it would give you 100. Okay? So it's useful to remember that if there hasn't been any inflation, pricing hasn't changed at all since the base year, then the deflator value would just be 100. And the higher the deflator value is, the more prices have increased since the base year. We would look at that number and say, well, in the base year, the deflator would have been 100. That's always the case. Here it is for 2016, it's now 111. So that would mean roughly prices have gone up by 11%, from 100 to 111. Okay. We'll do a lot more explaining how we use a price index. It's a very useful thing to be able to do because we're often comparing dollars in one year to dollars in another year. And if you don't know how to adjust for inflation, you're going to be you're going to draw some bad conclusions and make some bad decisions. Think about retiring. You know we're going to have inflation pretty much every year. And so the amounts that you would need to live on today will not be the amount you'll need to live on in 40 years. So in doing that planning, you have to make adjustments. And most people just depend on somebody else to do those adjustments for them. How do you know if they really know what they're doing? If they are making the right adjustments? I can tell you, I've had a number of former students who have gone on to be financial planners, and some of them I would not want them planning my financial future, because one person I'm thinking of in particular just barely got out of finance, and now he's planning people's futures. So financial planners are useful, they're good, but you don't want to just assume they know everything. You need to understand some basic things, and you can understand the basic things. You don't have to understand everything, understanding some basics is really very, very important to making good decisions. All right. As we said before, growth in real GDP per capita is usually the best reflection of changing living standards. In this here, we're just kind of summarizing some things. GDP is used to compare economic output across countries. We compare the U.S. with other countries at a point in time, but also to compare output over long periods of time. We go back and look at, well, how does our output this year compare with 10 years ago, 20 years ago, and so on. That's an important thing to do. Just looking at this year, we look at how much we produced in the first quarter of this year, and then we look at how much it fell in the second quarter. Okay? Everybody has a sense that, well, things changed a lot in the second quarter of the year, but it's not until you look at GDP that you see the magnitude of those changes. GDP dropped at an annual rate of 33% during the second quarter. That is a concrete evidence of how severe the economic consequences of the lockdown have been. We are also going to use GDP to measure short-run fluctuations in the economy. We said that over the long run, output increases at a little over 3% per year. Not every year, but on average, about that much. But in the short run, we see lots of fluctuations. And this brings us to a term no doubt you've heard, and that is the idea of a recession. What is a recession? You might think, well, it's a word that is used so often, there's got to be a clear consensus understanding of that word. And the reality is that, no, it has several different meanings. The closest thing to an official definition is what is listed here. There is an organization, it's kind of a think tank, called the NBER, the National Bureau of Economic Research. Most of the top economists over the last century have at some point worked at the NBER. They track how the economy is doing. They try to understand what causes recessions, what can we do to prevent recessions or minimize recessions. And you could say that they're pretty much the official arbiter. They're the official determiner of when we're in recession and when we aren't, and when a recession starts and when it stops. Okay? So their definition would be pretty important. When you hear that the most recent, well, prior to this, the most recent recession was during the financial crisis. And if you go and check, you'll see, well, it began in December of 2007. Who decided that? The NBER did. They have a committee of top economists, and they meet on a regular basis. They look at the data, and they vote. Should we call this a recession or not? And here's the definition that they use. A recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. From that definition, is it clear to you what a recession is? No, that's a pretty long definition. It's clear that if we're in a recession, things aren't going well. There are problems. But what precisely a recession is not clear from that definition. A significant decline. How significant? Across the economy. I mean, every single city, Half the cities, what does that mean exactly? Lasting more than a few months. Well, how many months? Visible in all these different variables. Does it have to be visible in all of them or half of them? Or, I mean, it's that definition, although it's very lengthy, doesn't tell you exactly what a recession is. Okay? And you'll be glad to know you do not have to remember that definition because it's long and it's not all that useful. Right? What you do want to remember is this. A recession, the general idea, is that it's a significant, widespread decline in real GDP and employment. Right? If we're in a recession, it conveys the idea that it's not that, well, we got this one little area that's having problems. It's that for the economy as a whole, right, something's going wrong. Real GDP, what are the things we care about? Real GDP and employment. Everything is going the wrong way. Real GDP is going down, employment is going down, and unemployment is going up. Also, it would be useful to remember this common definition. In fact, in the news, you may hear this listed as the official definition. Okay? It is the one that is used most often, and that is a recession is 2 consecutive quarterly declines in real GDP. Okay? So a quarter is a 3-month period. So according to this definition, we're in recession if the first or 1 quarter ends and real GDP has gone down. And then if we have another quarter and real GDP goes down again, then we would be in recession according to this definition. Right? It's not the official definition. There are times when it's declared that we were in a recession where this didn't actually happen. But as a general rule, this is a pretty good definition. 2 consecutive, one after the other, quarterly declines in real GDP. And it's funny, if you go to the NBER's website, where they have the official definition, they also have a note there that says the NBER does not define recession as 2 consecutive quarterly declines in real GDP. So that's not their definition, but it's a pretty good approximation. Okay? Any questions on that? All right, here you can see real GDP growth from 1950 to 2015. Okay? And this is so you got the time on the horizontal axis, you've got the percentage change from the preceding period on the vertical axis. Okay? And the thing I think that really stands out is that the growth rate is not constant. The average growth rate, 3.2, is represented by the red line. Okay? So that's what's happening on average, but you can see that the growth rate bounces all over the place. Been up to around 8%. Here, notice, this helps you put into perspective what's happened in this year. This is looking 1950 to 2015. The lowest growth rate, negative growth rate, was minus 2.5%. Okay? If we were to put second quarter of this year on this axis, then it couldn't stop at minus 5%. It would have to go down to minus 33%, okay? Which is, you can't even, how far off the chart is that? It's unthinkable, unthinkable. But that's what did happen. Right?
Way off of this chart. Right now.
Yeah, the what happened in the second quarter has been totally off. I mean, off the chart just doesn't cover it. Rather than being minus 5, it's minus 33%. Okay. But again, that's an annualized growth rate. That was for the second quarter. Since then, it's been going up, okay? But hasn't gotten back to where we were before. But it's important to grasp how off the chart the second quarter was, because then you realize, we're not going to bounce back to normal overnight. If you run into somebody and you kind of stumble down to your knee and you get back up, well, you can recover from that pretty quickly. If a semi hits you and knocks you to the ground unconscious, you don't say, well, it's been 10 minutes and he's still out. No, it's going to take a while before you recover from that semi. And so we need to recognize the shock, the magnitude of the shock that hit the economy in the second quarter. And we need to keep that in mind when we think about what should be done to deal with the current situation. Because it is not at all obvious what the best thing for the government to do to deal with the problem. And we will be getting to those kinds of questions once in a few chapters. Everything we're doing now is laying the groundwork so that we know how to think about these issues. Okay, when we talk, some more terms you want to be familiar with. When we talk about the business cycle, that's a very important term because you'll hear it. Okay? It just is referring to business fluctuations, and it is referring to short-run movements in real GDP. Okay? We know put time on this axis. If we put real GDP on this axis, we know that the trend line, which shows what's happening on average, we know the trend line is going to be something like that. Okay? On average, real GDP goes up by about 3% each year. But if we look at the actual GDP in each year, we've already seen that the growth rate bounces around, but the actual GDP does something like that. You have periods where we're above the trends. You have periods where we're below the trends. When we talk about the business cycle, we're talking about these short-run fluctuations around the trends. When we're in, it should be something more like that. We don't go vertically up. When the economy is in an expansion, things are improving, that would be where GDP is increasing. At some point, we hit what's called a peak. GDP is at a temporary high, and then output starts to go down. And when output is going down, what do we call that? This period where output is dropping, we're in recession. Then at some point we hit a low point, we hit a trough, or that's called a trough, and then we go into another expansion. Things start to improve again. So when you hear the term business cycle, it's talking about these fluctuations around the long run trends. We want to avoid a mistake that people often make. In two ways you can make it. One mistake is to say the only thing that matters is the short run fluctuations. It doesn't matter about what happens in the long run, it's the short run of fluctuations that matter. What do you think the other mistake is? The other is to say, well, the only thing that matters is the long run, and the short run fluctuations don't matter. The reality is the short run matters and the long run matters. What we would like this long run trend to be steeper. That would mean that on average output is going up faster. And we would like for the short run curve to be closer to the trend line so that we don't have as many fluctuations. Everybody agrees on what we would like. We would like a higher long run growth rate. We would like less instability, fewer fluctuations. The controversy is excuse me. Controversy is over what causes these fluctuations, and in particular, what can the government do to make things better? Everybody wants to minimize those fluctuations, but if the government takes action, will that minimize the fluctuations, or is the government causing those fluctuations? Huge disagreement there. And by the end of the course, we'll try to explain why people reach different conclusions on that. All right, problems with GDP. We talked about it's our main measure for assessing how the economy is doing. We talked about inflation. We got to adjust for that. But if we're using real GDP, then we've taken care of inflation. But there are some other problems. Illegal or underground market transactions are omitted. With GDP, we're trying to measure the value of all of those final goods and services produced during the year within the country's borders. But there are some transactions that are underground. That means the government doesn't see them. Sometimes it is because those transactions are illegal. You have Walter White selling meth. Well, obviously, he's not going to say, oh, I need to report this to the government because I don't want GDP numbers to be messed up. No, if you're doing something illegal, you're not going to report it to the government. And if we're trying to measure the value of all the things that were produced, then we should include things whether they're legal or not. But then underground market activity, this would refer to things that are completely legal to produce. They just don't get reported to the government. When I hired somebody to cut my tree, if he had said, well, I only take cash, right? Why might he do that? He may not be planning to report it to the government. Because if you take cash, then you could say, well, the government won't know I got this money, so I'm not going to report it on my taxes and I won't have to pay taxes. That happens a lot. A bit of advice, I would say, don't do that. One thing, if you don't report your income, you are breaking the law. I'd say morally there's a problem with that. But also, you can be audited. And if you are audited, the government can say, we want to look at everything that you have, your bank accounts, everything. And if you say, I didn't receive any taxable income last year, well, they look at your bank account, they see, well, you deposited $10,000 into your account. Where did that money come from? And if you say, well, I pick up aluminum cans and recycle them and it really adds up. They don't accept that. And with the IRS, you're being attacked here. With the IRS, you're pretty much guilty until you prove you're innocent. So if they find you have cash or money in your checking account that you cannot explain how you got it from a non-taxable source, then they will say, you owe tax on this. Plus, you owe a penalty. You owe interest on that because you didn't pay it when you were supposed to pay it. Plus, you owe a penalty because you didn't report it. And you can pay a substantial fee and you can go to prison. So I would encourage you to report your taxable income. And you might say, but how could, they're not likely to audit me. Well, if somebody calls up the IRS and says, Joe Smith, I think he's not reporting all of his income. Okay? If they investigate Joe Smith and they find out that he didn't report all of his income, then Joe Smith, or the guy who reports it, gets a kickback from the government. So there's an incentive for somebody to report you if you're not reporting your income. So report your income. What's important here is that it's estimated that in the U.S. between 10 and 20% of GDP, or the underground economy is between 10 and 20% of GDP, which means there's a substantial amount of activity that doesn't show up in our GDP numbers. And that's especially a problem if we have changes in the size of the underground economy. If tax rates are raised and a lot more people stop reporting their income, then GDP is going to go down, even if we're producing the same amount of output. GDP other problems does not count non-price production, okay? Home production. You mow your own yard. Okay? Or going back to my tree, if I had cut the tree myself, that would have been a valuable service I would have provided for myself, but it would not have been added to GDP because I didn't pay myself to do it. But when I pay somebody else to do it, then that's a market transaction that will be included in GDP. Take care of your own kids. That's a valuable service, but it's not going to add to GDP. You pay somebody else to do it, and that's going to add to GDP. Okay? GDP does not subtract the value of bads. Okay? It's only calculating the value of what was produced. So if we have pollution, okay, pollution is a bad thing. It reduces our health, reduces our well-being. The government does not try to estimate, well, how much did pollution hurt people during the year? This is not something that is done. Crime, also not going to make an adjustment. Oh, somebody was murdered, so that reduces GDP. If it prevents them from producing anything, then that would lower GDP. But the crime itself is not something that is an adjustment is made for. Also, natural disasters such as hurricanes. Here you've seen this before. My poor minivan that was destroyed by Laura. In calculating GDP for the year, the government doesn't say, well, that was worth $10,000 before the storm, and then it was worth nothing. Okay, that's a $10,000 loss to me, but that adjustment is not made in GDP because it's only measuring the value of what was produced during the year. Okay? So there's no adjustment for the loss that occurred due to the disaster. On the other hand, you see the bill. I paid $600 to somebody to take the tree away. That $600 that I paid, I was paying for a valuable service that he provided. So because of the storm, it destroyed my minivan, but that was irrelevant to GDP. I paid somebody to take the tree away, that added to GDP. So GDP, the point here is GDP is, although it's very useful, it's not a comprehensive measure of everything that affects our well-being. Here you see the second tree that was dropped on my driveway. Once again, that didn't make me better off, okay? But I had to call Hugo again. I had to pay him even more money. Okay? So in terms of how GDP was affected in my life, the storm raised GDP because I had to pay for these services being provided. The storm damaged my property, but GDP doesn't take that into account. It's an attempt to measure the value of the goods and services that were produced. And Hugo definitely provided a valuable service to me, and what he did should be included. We're not saying that GDP is wrong. We're just saying we have to recognize it doesn't take into account everything that affects our well-being. And there are things that make us worse off which can actually cause GDP to go up. A natural disaster sometime will do that. A war can do that. Sometimes we'll hear people say, well, war is good for the economy. No, war is not good for the economy. War is not good for the country. War is not good for people. But war sometimes will cause GDP to go up. But never think that just because GDP goes up, that means it's a good thing. And here are just some summary of important things from the chapter that we've already talked about. Okay. All right, we did not get to chapter 28. We will do all of chapter 28 next time. Once we cover it, I think you'll see the things that are important from that. Okay. Any questions? All right. I hope you all get power back soon. Don't worry about the sapling deadlines. I know that not your fault if you don't have power. All right. See you on Thursday.